How much of that is just due to gas prices, and how vulnerable does that leave the consumer to any upside in energy prices, considering we are still in a supply-constrained world and China is coming back online?
Sure. I think a lot of the improvement is because gasoline prices are lower. We kind of reached a peak with gasoline over the summer, and they've been coming off. And that's a really big break, especially for lower income consumers who are very much dependent upon gasoline for getting around. And also gasoline takes up a big share of their incomes. Now, consumers still are quite vulnerable because, as you said, energy prices could rise, certainly as there's greater demand out of China. And there's still some volatility in terms of refineries here in the U.S. as well as OPEC decisions around energy. But consumers are still facing high prices for food and shelter, which are also part of the mix.
You know, Dana, I'm wondering also, if you take a look at the data that you need to have more confidence here behind the consumer really coming back, what do you need to see before you think this is sustainable?
Well, I think we definitely need more data, and certainly the expectations gauge is key. The expectations gauge has been in and around or even below 80 for most of this year. So it's been signaling that consumers 6 months from that first initial reading were expecting a recession, and that's really right about now. And certainly when we look at today's number, that reading is still hovering just above the recession threshold.
Well, I wonder how much of the confidence from consumers as well has to do with the labor market. When you look at kind of the labor insights in this data, to me, it in some ways runs contradictory to what the Federal Reserve is trying to achieve. They want softness in the labor market, and yet it seems consumers are still feeling quite confident about their ability to get a job.
Well, I think that makes sense. And you're right, our index does really pick up on the employment, just given the questions that we ask. And the labor market's doing well. And a lot of that's a function of labor shortages in key industries, especially those industries where you physically must show up to work. They're still hiring. And so for many people, they're seeing that as an opportunity, and that should support their personal finances going forward. However, the Fed's work is showing up in the intentions for buying homes and durables. Certainly, financing is much more expensive for houses and autos and and furniture, things that you must finance.
Now, how sensitive is the consumer when it comes to a recession? Is it kind of the tail leading the dog here? How do you think about whether the consumer cracks first or the economy does?
Well, the consumer is part of the economy, and certainly consumer spending is roughly 75% of all of GDP. So we're already seeing the effects of monetary policy, but the lags vary depending upon the economic indicator. So certainly we're seeing that in housing activity. This morning we saw that home sales continued to fall. The other day, housing starts are coming off, and that's consistent with rising interest rates. And for consumers, it's really about how much disposable income they have and their willingness to spend it. They still have some savings, and they have credit cards, and they're definitely spending using credit cards. The key is whether or not they think they're going to have jobs in the future. And for now, it seems like they do believe that.
Well, Dana, income and spending power is one thing. Wealth is another. And as you talk about the deterioration we are seeing in the housing market, that is where the majority of Americans' wealth is tied up and is in the value of their homes. If those prices start to deflate in a material way, how does that impact confidence and sentiment?
Well, people don't usually spend out of wealth, but wealth does affect how you feel. But let's remember that home prices were rising before the pandemic, and then they pretty much went vertical. So what we're seeing is an unwind of that kind of unnatural spike in home prices. And even when you look at estimates of where people think home prices can land, even if they fall by 20 or 30%, the level would still be higher than what we were before the pandemic. So really, a lot of the gains in housing wealth that people experienced over the last year or two is quite artificial, and they're basically just giving back the extraordinary gains that they saw.